Good day and welcome on today's beautiful sunny Wednesday. Thank you for attending. We hope you're safe and well at home or at your offices. My name is Gerhard Hembusch, and on behalf of the Finance Department at the UTS Business School, I would like to welcome you to the third event in our series about the COVID-19 economic crisis. Today, we will shed light on topics including banking and credit. After an early analysis of the crisis in April and an analysis of equity markets in May, we continue our discussion today by discussing an updated view about the economy, as well as implications for banking, credit, and mortgages. Today's panelists include two of our resident experts. We will start with UTS Industry Professor Warren Hogan, who will discuss for approximately 15 minutes likely paths of the economy, unemployment, business conditions, and interest rates. After that, Professor of Finance and Banking expert Harry Scheule will take a closer look under the hood of banks to shed light on topics including loan deferrals and bank loss predictions. We finish with a commentary provided by a member of the financial industry. We are excited that Justin Tyler is joining us today to provide his views from a capital market perspective. Justin is a director at Daintree Capital, a Sydney-based firm that specializes in the management of absolute return income portfolios. Once again, welcome and thank you for attending. I will now ask Warren to take over the screen.
Thank you and welcome everyone. I will have 15 minutes, which of course is never enough time to talk about the fascinating world of the economy in this pandemic. So to get straight away, I wanted to, the task today is really to talk about the likely paths for the economy as a platform for Harry and Justin to discuss this credit issue. I would say that credit is at the heart of the economic story we now face. It's essentially a story about business solvency, and many of the policy measures that have been taken here and around the world have been aimed at making sure that we don't see a sudden surge of insolvent businesses due to the big downturn in economic activity, the result of the public health orders and various restrictions placed on the economy. Of course, those measures are aimed at making sure a liquidity problem and a short-term revenue problem doesn't become a solvency issue, but they will be removed at some stage, and there will be a time in the future where we will start to have much more clarity through both capital markets and the banking system about which businesses survive and which don't. Some estimates have that number as high as 1 in 6 businesses will fail. I think that's a particularly bleak estimate from the OECD about 6 weeks ago. But I would note that there is a standout feature of this cycle and the economic environment when we entered into the pandemic, and that is that we were carrying a lot of weak firms at the start of 2020. And I characterize that as firms that aren't financially strong, this concept of a zombie firm that has been facilitated by extremely easy monetary policy around the world, much lesser extent here in Australia, although there has been evidence of a big decline in the rate of administrations being recorded by ASIC in the last 5 years. And of course, the numbers in Q2 of this year were a record low since that database started in 2004. So really the message here is that, we're going to be waiting until all these temporary policy supports are removed, the moratoria is lifted, and at the moment that's not looking like happening before 2021. So in order to facilitate the debate, I'll look through some paths for the economy out there. Once I've given you sort of an overview of where I think we are, because we're now 4 months into this and we're starting to get some economic data. So this month has been a big month. It really highlights how much things have shifted in the way economic policy is conducted, not just here in Australia, but around the world. The RBA governor gave a very important speech saying that essentially monetary policy is in hibernation. They've done all they can, and this is a sensible view of monetary policy. And that is interest rates are at their low point, their effective lower bound of 0.25% for the cash rate. They now are targeting the 3-year government bond at 0.25%, which of course means all interest rates and maturities between 1 day and 3 years will be theoretically 0.25%. But they've ruled out negative rates as ineffective. And of course, they've sort of put to bed these sort of more fanciful ideas coming out of some sectors around direct monetisation, writing off government debt and all this sort of thing. They're now on the sidelines. And the reason this is a big shift is that it's essentially been the central bank that has looked after economic management in terms of economic performance for the last 30 years. They've been the main game. Fiscal policy has largely been more structural in nature and with the aim of keeping the budget in balance over the longer term. But now we really shift the focus towards fiscal policy with monetary policy and hibernation. I do note that the banks have extended the moratorium beyond September to early 2021. Really, the challenge here is that all of our economic policy levers are in the hands of elected officials. And this isn't necessarily a comment on elected officials. They don't have a great track record in the scope of recent history being the last 50 years or so. But the reality is that this is a very different environment where they haven't had this pressure on them. They haven't had to address all the issues the way they do now. I will make a quick comment that is really important for the outlook for the economy, that we have different stages of policy. We have this emergency policy, which is in place right now, the job seeker extension, the job keeper. This month they flagged its continuation, although it's a tapering in effect. And the reason that is that these policy stimulus, in the government's view and many economists' view, have to be removed. These emergency policies have to be removed before a recovery can get underway. And that takes us to phase 2 fiscal policy approach, which is what I call fiscal stimulus, which is all about kickstarting the recovery. Then there's sitting in the background the whole concept and issues around structural reform, taxation, industrial relations, regulation, and a whole range of different economic issues that are obviously being talked about. That needs to be talked about now. They shouldn't rush, but that's all about making sure the recovery is as strong as possible, productivity is as high as possible to get on top of the debt. Now, that's a whole thing to talk, a whole sort of webinar to talk about the debt side, so I won't go into that. But the performance of the economy over the next few years is critical around this sequencing issue, from emergency stimulus to what I call fiscal stimulus. And this is removing the job keeper in particular and starting to do infrastructure spending and spending on education and training and these sorts of things to get the economy going again. And the bottom line is if they pull the emergency stimulus too quickly, then the economy could re-slump, that you could see a lot of job losses come through as job keepers pulled back. And you could see a fall in demand in the economy, and you could restart sort of a vicious cycle of falling demand and falling investment. So they don't want to pull it too early, but then again, they have to remove it, A, because they view it as expensive, although that's debatable in terms of government debt and what the government can afford. But more importantly, they do strongly believe, and I do support this to a large extent, that you do need to actually remove your job keeper to free the labour market up to get the jobs going in the right direction. That is, there are going to be firms that can't find labour because there's labour attached to weak firms that won't leave because of the JobKeeper program. But you've got to get it right. At the moment, the government's come through this month and said that starts in October. And although it seems like a modest tapering from October through into Q1 next year, the reality is it's a very big fall, and I'll come back to that in my scenario piece. In terms of an update on where we are right now, this is the weekly payrolls data that the ABS has been releasing through the pandemic. And unfortunately, we're seeing the recovery evident in May and June run right out of steam in late June and July. This is up to 11th of July. It doesn't really account for the worst of the Victorian lockdowns. So we can see quite clearly here another data point that shows until we get on top of the health issue, we're not going to get the economic recovery. And we're still faced at this stage with a pretty modest bounce in jobs, well below the levels of where they were pre-pandemic. And the next month or so of data is going to be very important. I just want to note here, this is open table data, and it shows how this health side is so important to the economy. This is the annual change in bookings. So you can see when the pandemic struck around the world, everything went to negative 100%, i.e. restaurants were shut. Then you get the big bounce back on reopening. But as soon as you start to see a second wave, you get a big tailing off of activity once again. And the point I want to make here is, and I think this is a critical point in how different state governments here in Australia are approaching this, is that whether or not governments go to full lockdown like they have in Victoria, here in New South Wales, we're getting a bit of a taste for whether or not the fact that there's a pickup in cases undermines confidence and stops people going up. So it's not so much that it's about what the government restrictions are, although that's important. It's the fact that the virus is still there. In terms of what the government capacity, we've had the government update. The government's capacity to support the economy is substantial in this country. So I just wanted to reinforce this message because it does highlight that the government can extend its emergency supports if the health situation isn't under control. The world average level of public debt, gross debt to GDP is 100. For the advanced economies, this is IMF data, it's about 131. And in Australia, we're at 56 in 2020 is their estimate, rising under the government's projections to around 68%. Is the number I've typed in there after the update from the government last week. The government's update last week, I believe, is essentially best case scenario at this stage of the game. And that's based on their assumptions around the health outcomes, which is essentially all domestic restrictions are lifted, including the 4 square metre rule by the end of December, and that we have full open international borders by 1 July next year. I believe that is substantially too optimistic. The government's projections for debt at 300 billion, or the hit to the budget, I should say, of 300 billion, which largely will be funded by debt in 1920 and 2021, are also very optimistic. I actually think that when you add in 21, 22, like 3 years, it's going to be more than double that. And that's not a problem because those debt levels we've got are high. Yes, we have to consider in this country that we have a high private sector debt, and that's what Harry will talk about in terms of banks and mortgages. And you also have to consider that this has to be paid back. There's no, fairy dust. There's no silver bullet, as some people might have you believe, from the MMT side. So there are constraints, but we still have plenty of fiscal space. So into the recovery paths, I've obviously been looking at this closely from the get-go, from March. And I think the U-shaped recovery, which is essentially the government forecast presented last week, is our best case, given what I just said about the health assumptions. The Treasury's explicitly got them in their documents that were released last week. And that underpins the government's removal, I believe, of JobKeeper and the winding back of JobSeeker over the 6 months from September. So they're selling it as obviously an extension and a virtue that they're extending it. But of course, it may be too early at this stage because I think there's a W-shaped recovery. And if the government policy as planned comes through, I think we're going to see job losses come through. You continue to get JobKeeper as a firm if you're 30% down, same criteria as before. But that doesn't mean that your firm's going to be back to where it was pre-COVID. So there's going to be a whole range of businesses at -10, -20 that have been getting JobKeeper that won't be able to hold the current staffing levels when they don't have JobKeeper. And I think that's the W-shaped recovery, which I'll show you a picture on. And then there's the worst case, which is the L-shaped, which is a diabolical health outcomes. And I'm not going to dwell on it too much because I don't think it's a high probability. These are the government's numbers. I'm running out of time, so I'm not going to go through the effective unemployment rate other to say that it's essentially saying what the unemployment rate would be if all people who've lost jobs are accounted as being in the workforce and also all the people on JobKeeper not working. It's obviously improved a little bit, but it's still way above the official forecast for unemployment. The government, the best case, I believe we're going to get is unemployment reaching 9% later this year. I think that's a best case scenario. So this is the sort of the scenario chart. This is employment through the last 2 recessions of the early 80s, early 90s, indexed to the peak. The current loss of jobs, you can see in blue, which has been substantial. Then the bounce back in June. Then we have what I call the W-shaped case, where you have further improvements, although more modest than I thought a month ago because of Victoria, through the next few months. And then you have a re-loss of jobs in Q4 as JobKeeper comes off. Then you have a recovery in 21. That's what I call the W. The best case, the U, is the government's, is the orange line. I haven't put in precise numbers, but you can get the idea. And the worst case, the L, is a much more lethargic recovery and a worse outcome than we've seen in the modern era for the labour market for the next few years. So to summarise back to this chart, under the best case, at the end of 2021, the unemployment rate is likely to be around 8 or a bit lower, which is a pretty good outcome. Under the W scenario, the unemployment rate peaks, in my view, mid-21 at around 11 and comes down only to 10 at the end of 21. And then under the worst case, you're looking at 12% plus unemployment at the end of 21. And I believe that is the focus for credit analysis in terms of the banking system and the broader economy, is where the unemployment rate will be sitting at the end of 21. I think that's your range of likely outcomes, somewhere between 8 and 12. All right, I'll just conclude with interest rates. We just did a government 30-year bond issue here in this country yesterday. I think it was just under 2% it was priced at. These are 30-year yields from around the world. The bottom line is that, as I've said, interest rates are going to essentially remain low for an extended period. The 30-year bond is a forward indicator of where short-term interest rates will be for the next 30 years, is telling us they'll be very low. So I don't think the credit issue is going to come down to interest rates in any way, shape or form. That was part of the pre-pandemic environment of low interest rates, zombie firms, this sort of thing. The variable around credit from a macro point of view is unemployment and the level of economic activity. All right, I'll leave it there and hand it back to Gerhard.
Thank you, Warren. Thank you very much. And now we have time, probably again, approximately 15 minutes for Professor of Finance and Banking expert Harry Scheule, who will take a closer look at banks.
Yeah, so I want to, so the way we have structured this is that I now build on Warren's economic forecasts for the next years and have a bit of a discussion on what it may mean for the banking system. And I want to focus on three elements of the banks: the current loan deferments, the bank loan loss provisions, and the bank capital. Maybe as a starter, let's have a look at the current numbers a little bit. We have seen a substantial number of loan deferments. The concept of loan deferment is a fairly new concept, I would say. What it means is that customers or borrowers, I should say, can defer their repayments on their mortgage loans or any other loan for a period of time. Initially, it was set up that the period of time was 6 months, as Warren explained. It was now increased to 10 months. Further increases might be discussed in the future, but as it stands now, we talk about loan deferments until early next year. On the right-hand side, we have a chart, and it shows what it meant to the banking system. And the Australian banking system is large, and the loan deferments mainly apply to two categories, that is the mortgage loans and the SME loans, the small and medium-sized enterprise loans. And the total loan volume of these loans in Australia is about $2.6 billion. And we see that the current deferments have reached $260 billion. It's very substantial. It's 10% of the bank's loan book. So 10% of the bank's loan book have asked for a loan deferment. What it means is customers have to fill out a form. It's a standardized form for most banks, submitted to the bank, and then the bank defers the loan. Now, we have here a split up of these loan deferments in SME and housing loans. We see that currently the loan deferments are dominated by the SME loans. It's also not surprising. I think this is kind of predicted because the unemployment rate, yes, drives the loan deferments, but many people get substitute payments from the government through JobKeeper and JobSeeker. And with that, not everyone requires a loan deferment. Whereas if you are a small company and you're working in the service industry and as a consequence of a shutdown, you either have reduced earnings or no earnings at all, those entities struggle the most. And we clearly see that in the loan deferment space. Now, obviously, the total deferments are much greater in the housing segment because the housing loans are the bulk of the loan exposures for Australian banks. About 80% of Australian bank loans relate to the mortgages. I should also say there have been different mitigants instigated by the government to mitigate the effects of COVID. And the substitute payments had kind of a mission to keep people's earnings going. And loan deferments, but also the eviction moratorium instigated by the governments had a different purpose. They basically called it a break on current payments. And with that, all of these measures are intended to mitigate the outcomes of COVID. But the way they're implemented, there's a slight misalignment between these policies. Now, the big question with these loan deferments effectively is that, at the moment, because loan deferment is a policy tool, and the policy tool is a little bit hidden. Basically, what's happening is the regulator, APRA in Australia, says, okay, if customers defer loans, that is different to normal hardship, that is defaults or delinquencies in that instance, that, or in that way, that banks do not have to run the loan deferments through the normal workout procedures. Normally, if there's a delinquency in excess of a certain number of days, it triggers a whole chain of consequences within the bank, loosely speaking, a foreclosure process. And what APRA is saying is, for the loan deferments that fall within these various criteria and within the time period we just discussed, the banks do not have to work these loans out, and they do not have to provision or provide extra capital for these loans. And now the big question is, we've seen 10% of the loan book is already deferred. Numbers are increasing. As Warren said, the big driver is unemployment rates, and doesn't look so rosy in Australia because these job seeker and job keeper payments will run out, and the unemployment rates are predicted to go up, either translating into V, U, or W shape outcomes. And from a banking perspective, the question is now, what does it mean from the loan deferments? Does it mean that all of these 10% that currently have been deferred, but they will become delinquent and default? Or is it only a fraction of these? Because the outcomes can be the borrower resumes payments, either because the hardship is gone, the borrower has cured, or alternatively, the application for loan deferment, and this might be also a reason, could have been strategic from first moment on, but the borrower just asked for loan deferment even though that didn't really need it. The reasons for that we could discuss. But also another outcome could be the extension of the deferment, but eventually one hard outcome could be a hardship arrangement that is coding that default as or that loan deferment as a delinquency, and eventually it is a default. And so, people have been asked by the newspapers recently what they think would be a conversion ratio from loan deferments to delinquency default. And most experts believe currently it's going to be between 0 and 40%. In the mortgage space, the 40% is not so bad, because if 4% of your loan books eventually get delinquent or have a loss, then there's still assuming a certain loss given default, the loss for a bank is limited. And if you go back in time, and Warren has mentioned there were prior crises, and I suspect one of his crises he plotted on the charts related to the 1991 crisis, the bank losses of the major banks in that year were larger than that. But that said, the current numbers are only the start, they're increasing, and the big problem and big unknown is the unemployment rate, as Warren highlighted. How big will the unemployment rate be when these government subsidies, JobKeeper and JobSeeker, run out? Apologies, JobKeeper run out. Now, there's another aspect I want to add, and I know currently we talk a little bit about inflation rates because new numbers come out, and the general thinking is, because of COVID, prices will come down, and it's going to be good for the borrowers because mortgage borrowers, the way they service a mortgage is basically from the difference between the incomes and the expenditures. And obviously, the less borrowers have to spend on necessities, the more they would have available to service mortgages. And there was a very interesting study I found coming out from State Street last week, and it basically said, this COVID has other impacts as well. And it has, for instance, the impact of a changing in the consumer expenditure profiles. And if all of us, I think, these days we are traveling less, we are spending less on entertainment, going out, but all of us spend more on groceries. And this study sort of analyzed how is the spending pattern evolving given COVID. And it's finding that actually for some countries, it's finding that prices or the CPI inflation rates are going up rather than down because people have changed their expenditure profiles. And again, the question is it going to be a short-term phenomena, or is it going to be something fundamental? Are we as a society changing into different expenditures, but also different price patterns because of COVID? And I just want to remind that global supply chains are still distorted. And what we haven't seen is, for example, in the agricultural sector, because we have only had a few months, we haven't seen the harvest patterns and the production cycles that come post-COVID. And so this can have a fundamental change on prices that we as consumers are experiencing. And only yesterday, the UN came out that, with a number of 10,000 children are dying globally per month post-COVID because food prices have gone up in certain areas. And this is just a reflection of something, a broader trend that might have started. Now, what is the impact of all of that? We have done some studies at UTS. I guess we have done it for the past 20 years, analyzing credit risk in banking, and we have linked it to all sorts of features. I think the features what are interesting for our ends is now that we most borrowers will experience through unemployment or demotion or cutting of bonuses and the like, a drop in salaries. And that's definitely the biggest driver. We may see that expenses are going up, but another thing that we may also experience are changing to our house prices, housing markets. And the trend is a little bit unclear. Many people believe housing prices are going down as a shock to the market, and in parts we have seen drops in the housing prices. But like the share markets, not to the degree we expected. And the share markets have rebounded, but the housing markets have low volumes at the moment, but the prices have not come down to as much as people had predicted. What it does do is currently it supports the mortgage markets. But just imagine a scenario where house prices drop. It will have severe consequences on the loss rates that banks face. Also, even before that, it has consequences on the ability of borrowers to seek refinance. I'll explain to it in a second. Now, this chart is interesting because what it does do, it summarizes, call it the net of, this is an income chart, but you could just call it a shock. And the shock being the reduction of disposable income, that's the income less the expenses. So the shock can come from the income side or the expense side. And it shows the impact of the shock on the delinquency or the risk of banks. And we see here that clearly the greater the shock, the greater the risk. One other feature there is the population that grows the greatest in risk for banks. That's the low income segment. So lower income people or households, or perhaps the same holds then for businesses, are more exposed to income shocks. There's another feature. The banking system has in the last years shifted from a one-year loan loss provisioning system to an IFRS 9 loan loss provisioning system. What that means is loan loss provisions for banks have become pro-cyclical, in the sense that if we now go through a crisis, banks have to ramp up their loan loss provisions, and they have done that already. But if there will be a conversion from deferments to defaults, we will see a very stark increase in bank risk measures. These risk measures are called PDs, and what will happen is that banks will be forced to account that for their portfolios shifting from a one-year accounting practice to a multi-year accounting practice. And that combined with some other effects might go too far for today's presentation. But a very, very strong driver there is the lifetime of mortgages. And I just want to make this point. We all know mortgages have 30-year lifetime, but many banks in their accounting processes consider only the average lifetime on the books, and that might be, say, 5 to 7 years. Now, in a low interest rate environment, in a very constrained environment, what we will see that this lifetime on the books of banks will substantially increase, and with that, the loan loss provisioning process. There's some research that we have done, and there's a reference here if you want to look up the paper to get a more thorough understanding. This is just a chart that shows that switch. Pre-COVID, we are working off a one-year loss scenario post-COVID, the banks will shift into multi-year loan loss provisioning, substantially increasing the provisions. And the outcome of that will be less eligible Tier 1 capital for the banks and the need for further capital. And that is another discussion. The banking system will struggle where to get depleted capital going forward. In normal environment, it would come from retention of earnings, share issuances, but all these channels will become very constrained in scenarios that Warren has outlined in his talk. Here, this chart just shows the loan loss provisions of banks, and they have started increasing the loan loss provisions, all of the banks. A bit of a disclaimer, I self-created the loan loss provisions for CBA based on media announcements, because CBA has not, when I last checked, come out with their latest provisions. I should also say that these provision numbers are always a bit lagged, because the ones I chose might be a month or 2 months old, and as we go forward in the next months, I expect further increases. But you already get a feeling that the loan loss provisions in banks have increased by a factor of, say, 4 on average. So that's substantial. What's the impact? What's the impact on property buyers and SMEs? A first consequence will be get tighter. Getting credit will become much harder. Banks will increase the lending, have already increased the lending standards, also the insurance standards. It does mean access to loans and also to insurance products in the property space, mortgage, landlord, trade credit insurance will become more restricted, often unavailable. There are some anecdotal evidences where banks, even today, there was a story about St. George Bank a few weeks ago, come up with teaser products in this environment, suggesting we are at normal times, and it's still a very much a market and marketing driven environment. I do not personally believe in that story. We see, when we look at lending volumes, that they have already dropped. The ABS is collecting data. We see owner-occupied loans have decreased by 10%, investor loans by 15% in volume. We also see increases in credit spreads. Also, there's anecdotal evidence that, in particular, these loan deferments, it's not so much of an issue for mortgage borrowers, but maybe for companies, to the degree that they sought for loan deferments and then obviously apply perhaps for a follow-up loan with the bank. But the previous loan deferment is seen as a negative credit feature in the risk analysis. And again, the housing market, there could be further negative effects next to unemployment rate coming from the housing markets that may further exacerbate and increase the credit risk on the banking side. This is a chart from the ABS data. It just shows the lending volumes, and so actually it's not too frightening at this stage. For example, the blue line is the owner-occupied lending volumes originated by the banks, and that has increased in the last years prior to COVID. In Australia, the mortgage markets, residential mortgage markets, and housing markets were booming, and with that we have seen a decline. That's a decline of 15%. It's documented by the ABS as of May. But if I look at this line, then I say, oh, we're still in good times, so it's not too bad. But the trouble is that kink here, that drop off, and that drop off is expected to decline further. Other markets like the investor markets and the also first home buyer markets, they were at lower levels and did not grow that much prior to COVID. I think from an academic standpoint, or also in the banking system, there are problems. One problem is, for example, that bank loan loss provisions and capital, the way we structured them for IFRS 9 accounting, and also the link of IFRS 9 accounting to bank capital levels, they are pro-cyclical. And so we have higher provisions and lower capital amounts in crises. That's an issue. And also for the loan deferments, there's a problem because most bank systems, they're not as flexible as we think. So we think, okay, Now we do a loan deferment, and for a bank, it's very easy to handle loan deferments. If you look and talk with people working inside banks, they actually acknowledge that the systems have been set up to this old world where you have either current loans or delinquent and defaulted loans, and just resetting the systems to accommodate for this new category of loan deferments is a challenge within the banks. And it's the first time, I think, that this change has been brought to banks. There have been other episodes where there were hardships in Australia. Think about the Queensland floods in, I think, 2010 or 10, I think. That those shocks to the system were dealt within the existing system architecture of banks. But the loan deferment causes new challenges to banks. What we're currently working on, maybe just as a bit of a promoter at UTS, is rethinking the existing prudential banking systems as to whether there are better ways to account for credit losses. And we are thinking along the lines, it has been discussed, countercyclical capital buffers in the past. They have not been fully implemented in Australia. And we are thinking along the ways whether there could be safety mechanisms. Now it's too late to create them, but perhaps to accommodate for the next shock. I think this is where our research over the next years will play a major role. Thank you very much.
Thank you very much, Harry. We now have Justin Tyler, who provides a capital market view. Justin is director with Daintree Capital, as I said, a Sydney-based firm that specializes in the management of absolute return income portfolios.
Thanks, Gerhard. It's a pleasure to be on the webinar today. Thanks, everyone, for your time. I'm going to first follow up some of Harry's comments about Australian housing from more of a macro perspective. And that will feed through to, I guess, some comments that follow on from points that Warren made a little earlier. But first, I guess, a single point on the Australian banks. I agree with Harry. There probably will be a need for further capital raisings down the track. But I'd make the point that Australian banks are and likely will remain in a relatively strong position from a global comparative standpoints. And, I expect, given that will continue to be the case, it's difficult to see systemic issues flowing from the housing market. Nonetheless, the housing market is, I think, probably my primary point of concern at this point as far as the domestic outlook is concerned. And it's been a very long time since I've said that. I think one of the points that gets very little airplay in Australia, one of the trends, I should say, it probably should get more airplay, is our population growth. If you look since 2018, Australia's population growth momentum has actually been falling. That is to say that the population has been growing, but at an ever slower rate. COVID, unfortunately, will exacerbate that trend, because actually most of Australia's population growth is driven by net migration. If you look at the natural rate, it's a very smooth trend by comparison. So changes in our population are very much a focus, firstly, of net migration, and a distant second, the natural rate of growth. So Australia's borders now are closed, and turning the immigration tap off essentially overnight, make no mistake, I think that'll have quite a deleterious impact on Australia's housing market, and overseas travel likely to be stopped at least until sort of mid next year. I think it will take some time for Australia's immigration growth to reach previous levels. So you've got, on the one side, this population trend that I'm talking about. On the other side, if you look at labour market trends and ask, well, which demographic has been most impacted by the coronavirus, and I think you'd have to say it's young people. It's the under 30s who've been impacted most heavily. So property investors then are going to come under some pressure, because occupancy in this age group will fall. After all, it is this age group that's key to household formation. There may be some offsetting trends in other parts of the demographic spectrum, but I think it will make increasing sense for investors to sell assets, to sell their housing assets, because the income is now negative. And given the point I just made about population, I think the capital gain impetus is now much less than what it was. And then you follow that up with Harry's points about constraints on credit availability. I think that puts the Australian housing market in a relatively difficult position. I think the positive is that on the owner-occupier side, I don't expect a slew of selling, because there's been a lot of equity built up in aggregate over a number of years, and I think it'll be sufficient to avoid that. That means that as far as an impact on banks, I think it's probably a short-term impact that we might expect, rather than a sort of larger systemic impact. And indeed, if there was a sign of a larger systemic impact, that'd be something that policymakers would be desperate to avoid. So I think as housing turnover increases over the next year or two, we might see a bit of a fall in housing prices. Nothing major, but certainly it bears watching. It bears watching particularly because if you do see house prices accelerating downward, then that's going to have a really negative effect on the household sector, and I should say. And of course, it's the household sector that is expected by policymakers to step up and spend. And prolonged weakness in housing prices would really throw quite a large spanner in the works. The importance of the household sector to sort of broader economic performance raises another important question, I think, and that is income growth. Investors are screaming for yields in this current environment. Indeed, one of the main reasons that we formed Daintree Capital was to service that need. Of course, though, investment returns are only one side of the coin, and ultimately income growth in the economy is inextricably linked to wages, and that's where I'm going to focus next, on wages, on productivity, and on debt. I think it's crucial that productivity is raised in Australia, because this is the only way we're going to have a sustainable wage growth. And unfortunately, this has been an issue with the Australian economy for some time. Low wage growth, lacklustre productivity, really this has been an issue since the end of the mining boom. And so government policy is going to need to change, but the policy prescription is very difficult. If we just take one example, let's look at the case of business investment. In Australia, prior to COVID, business investment was very, very low. You'd almost say recessionary. And in my mind, it's difficult to see in this new environment why businesses will want to invest in Australia, even if there's an increased tax benefit. And I think there's three reasons for that. The first one is that this weak investment is not just an Australian issue. It's a broader issue in developed markets, because quite simply, EM countries have been a more attractive destination for investment because returns or expected returns are higher. The second issue is that this recession has been unusual in that it's hit the service sectors particularly hard. What that means is that you're not going to have the diminution of the capital stock that you usually have. And so therefore, you're probably not going to have the sort of bounce in construction that you often get when you come out of a recession. And thirdly, even if you disbelieve the first 2 points that I've made, I think it's pretty clear that demand more generally in Australia has been very weak, as I've mentioned, since before COVID, and this shock is not going to reverse that. This shock is not going to see households, racing to shopping malls and spending. In fact, you're going to see the opposite. You're going to see an increase in precautionary savings. So without investment to prop up productivity, I think it's going to be impossible actually to move to an environment of productive growth that's sufficient to erode the debt burden that Australia has ended up with as a result of the unprecedented fiscal stimulus of the last few months, and also the loss of tax revenues over the last few months. Now, as Harry mentioned, as Warren mentioned, I should say, by developed market standards, Australia's debt position is manageable. if you believe the government's latest projections, you'll see net debt of 35.7% of GDP by mid next year. That's a vastly better position than most other countries find themselves in, although I do agree with Warren that is best case, not base case. So the hard work for policymakers really starts now, and we've heard a lot of talk over the last few days about supply side reform as a way of dealing with the debt burden. But I'm not holding my breath on that. I would echo Ross Gittins' article in the Herald this morning. If you haven't read it, I'd urge you to go and read it. These sorts of reforms are hard. They usually involve the slaughter of any number of sacred cows. I'm talking increased rates of GST. I'm talking changes to universal Medicare, and so on. Everything has to be on the table, and I just don't think the government has the wherewithal to start those sorts of conversations. So, putting it bluntly, at this point, I think it's going to be impossible for Australia to fully grow its way out of the debt we're in. Growth will help a little bit, but, and I'm certainly, by the way, I'm not saying that we end up stuck in a recessionary growth environment forever either. I'm merely saying that the growth that we end up with in the medium to longer term is going to be on the low side of historical precedent and not enough on its own to erode the debt burden that we have. And so if I summarize, I'd say that there's probably three certainties that I point to in the outlook over the next little while. One is that households will save more. Two is that businesses will invest less. And three is that government debt levels will remain high for quite some period of time. That really is a recipe for financial repression, because if you're not going to grow your way out of debt, as Warren mentioned, the debt has to be paid. It's a recipe in my mind for financial repression and perhaps for stagflation. And in fact, markets are already pricing that in. You're seeing real yields on government paper punching through record low negative levels at this point. Inflation expectations are rising. Gold prices are going through the roof, as we all know. And I think that these three trends can continue for a while yet. I'll just conclude by saying a little bit more about the inflation backdrop, because I think that's really interesting at the moment. What I think is interesting about it is that what we're seeing is a realignment of supply chains globally. In Australia, there's going to be, and elsewhere, there's going to be a preference on the part of some in the economy to onshore. That preference will come from reasons such as health, the desire to have healthcare more strictly controlled locally. National security is another reason that I can think of. And so for some sectors of the economy, if prices rise as a result of supply chain realignment, well, so be it. At the same time, as this recession moves forward, I think we'll see some destruction of capacity. Harry's already mentioned the potential for steeper loan losses. And if we do see a destruction of capacity, then obviously that lowers the bar for inflation. And I think the other point that's worth mentioning is the rise in protectionism. We're seeing that, of course. And so all of these things, they're not inflationary today. I think the deflationary impulse is much stronger. We saw that in the CPI figure that was released this morning. But in the long term, I think all of these things are inflationary. I guess I'm not fully across the line on the long-term inflation story as yet, because as I mentioned earlier, it is reasonable to expect demand to stay weak, particularly in the household sector, for some time as people build precautionary savings buffers up. In that sort of environment, I think it's too simplistic just to point to central bank monetization of government debt as a driver of inflation, because the liquidity they provide, and we've seen this in the post-GFC period, the liquidity they provide just ends up getting locked in bank vaults as the velocity of money plummets. So I'm not convinced on the long-term inflation story. I'm merely pointing out the risks. I think that the uncertainty around longer term inflation outcomes has certainly risen, and that in itself is enough to increase the inflation risk premiums in markets. That is the inflation risk premium component of real yields. And I think therefore this is a risk that investors need to consider carefully and protect themselves against while this protection is reasonably priced. Thanks, Gerhard. I'll leave it there and I'll let you open up the forum for questions.
Many thanks, Justin. That was great. And since we have only a few minutes left, I want to straight jump into questions. Justin, if you like, I have a question for you that I hand over then to Harry. Have you seen figures on lending from non-banks to SMEs? Or has anybody looked at the whole lending market to SMEs?
No, I haven't. I haven't seen those.
And allow me to...
Hospital part of Harry, maybe he has.
Harry, do you have a view on that?
I think for Australia, the non-banks play a very minor role. All the fintechs and the non-bank lenders are very small. Unfortunately, we want more competition in this country, which is dominated by 4 very large banks. That said, in other countries like the US, you've seen a sharp increase in the non-bank lending activity pre-COVID. But our experience actually is globally, I would say, is a bad one with non-bank lenders in crisis because they're all bond funded and as not at the moment, but if you go back in 2007-8, there was a big liquidity shortage, or people couldn't issue bonds to get funding for their lending activities. And at least in this country, it meant that a lot of a few non-bank lenders we had, some of them were merged with existing banks, and so it's usually the non-bank lenders that are much more cyclical and provide even a lower amount of loans in economic downturns. So there's not going to be a source of recovery or mitigation. It's going to be a source of problem, if at all. But unfortunately, in this case, we don't have too many in Australia in terms of volume.
Thank you, Harry. And we have a question for Warren that we can also hand over maybe then to Justin. Warren, what is your view on the US dollar in short term and medium term? If we get an equity market meltdown, do you think funds flow back in the US dollar as a safe haven? What are your views vis-a-vis regarding the Aussie dollar?
Thanks, Gerhard. So not a strong view. There certainly will be a safe haven inflow to US dollars if there's significant market disruptions. And I think we've seen that time and again. So I think we can safely say that. I think the US dollar is probably a little overvalued at the moment, not a lot. And I think the Australian dollar is certainly got strong underpinnings. It's very hard to say with the currencies. I really don't have a strong view, and that's because there are so many different ways this could play out. If we look at some of the worst case scenarios of extended sort of deglobalization and extended restrictions on the economy, I would argue that Australia is extremely well positioned as a primary commodity exporter. We're benefiting greatly now, of course, from high prices for things like iron ore and gold. We sell or we produce 3 times as much food as we need domestically, so we produce enough to feed 75 million people. So as you strip away and look at fundamentals, those are things that are going to continue to trade across borders, even in a deglobalization phase. So in a funny way, I know this is counterintuitive, I actually think the worse things are, the better it looks for the Australian dollar, because we're going to be needed by the rest of the world greatly.
Great, thank you very much, Warren. And Justin, do you have a view on the currency situation?
Look, I agree with everything that Warren just said, to be honest. I think that the US dollar has some further downside, although probably not near term. I think if you look at positioning data at the moment, the US dollar is a very large short in markets at the moment. So you might expect some consolidation around these levels, but the US dollar can sort of roughly be characterized as a tug of war between 2 forces. On the one hand, the US, or by 3 forces really, the US domestic situation, the fact that it's the global reserve currency, and also linked to that, the safe haven bid. All of those things are important to the US dollar at various times. But medium term, yeah, it wouldn't surprise me at all if the growth environment remains, particularly if the US continues to underperform insofar as its response to coronavirus, then yeah, the US dollar can continue to sell off a bit from here.
Thanks, Justin. And I have a question for Harry, who had previously commented on real estate. Observing the world's financial and cultural centers becoming ghost towns, what are the flow-on effects of a change in workplace choices that is home office for life? What will be the impact on banks, super funds, and other players that own these buildings?
Yeah, so first of all, I think the housing markets next to unemployment is probably the other key figure in this country that matters, especially for the banks and the credit risk considerations. And pretty much anything is on the table now. We're talking about a complete overhaul of a tax system, a change of our consumption habits, as you say. Some people may work from home, and we all have friends that have had some change in, or including ourselves in their preferences. And so we, for example, have seen people who moved out of Sydney to work from the countryside because it's cheaper and nicer and we will see maybe those changes. I'm not convinced that prices will go either way. But I can see that there's a risk of a substantial correction in the housing markets. I think Otto had a question along that. We have seen price changes in the housing markets. And the only problem is currently what people have done is they have taken 3 months of negative returns and they have annualized them or even multiplied it by a couple of years. And then you get shock scenarios with 50% down, things like that. And I'm not convinced that this will be as far as the housing markets go, in part of because Justin's in inflation story and the corrections we've seen in the share markets and the increase in the gold markets. And I think the housing markets are considered to be a little bit like a safe harbor in Australia, but I do not know whether they're fully sheltered from an impact. I also note the issue of migration. Yes, there's no migrants coming to Australia, but at the same time, there's hundreds of thousands of Australians currently repatriated to this country. I'm not sure they need housing. But also I see today in news that the New South Wales government has changed the land tax for build-to-rent schemes. So they're putting effort in building more houses. I'm not sure how that's going to play out. So going forward, we will have differences in the supply. And all that means that by and large, I think we live in a world of greater uncertainty. The only safe bet I have at this stage is the increase in premiums in the prices. And that already has a fundamental impact on a number of issues. But I'm not privileged or I'm not confident enough to say house prices go up or down, urban versus rural properties go up or down. Unfortunately, I cannot provide any investment advice to anyone present today.
Thank you, Harry. And I would like to close with another 2 questions, please. Warren spoke a bit about the fiscal stimulus, and I wonder if he has a view on what this is likely to look like and or what he thinks it should look like. And Warren, if you can be brief, please.
Sure. Okay, so the fiscal stimulus is stage 2. It replaces the emergency supports. Whether that's going to sort of happen at the end of this year and early next year, or whether you push out a bit into 2021, will depend on the health situation and the economic momentum. It's all about re-kicking a virtuous cycle of higher spending, higher employment, higher investment. So it's direct government action in the economy. It's largely infrastructure. So right now, the infrastructure planners need to be bringing forward all their projects as best they can, but they also need to look at how the world's changed, whether or not there's preferences for where people live, this sort of thing. That's a big one. I think they need to invest in people. That's infrastructure, labour, whether it's in the universities, in skilling and reskilling, and what have you. So I see the things like tax cuts as structural. And I don't think tax cuts by themselves get the economy going. So it's really about direct injection of money. And maybe more handouts are required next year. Maybe we need to hit low-income earners once again with some payments.
Thank you, Warren. And I throw the last question at you too. How will the impacts of Victoria's virus lockdown impact the national jobs and spending recovery? And what if Sydney flames up next?
Yeah, so Victoria's obviously a quarter of the economy. I think the estimates are it knocks off sort of 0.75 of a percentage point of growth from Q3. I trust the Treasury forecasts on that. But we're seeing here in New South Wales the contrast. I mentioned it earlier, that even if you don't get lockdowns, if there's a pickup in the virus case count, that people shy away. I'm seeing in my everyday life in the sort of organisations I'm involved with, that people are getting more wary. So I think the reality is that Victoria, even if they come out in 6 weeks as currently planned and as the government forecasts assumed, it's just all going to be about how much sort of virus risk in third wave, I suppose, going forward. Here in New South Wales, the government wants to keep the place open, but if Gladys is faced with 100 to 150 cases a day, she'll probably go into some kind of a lockdown. That doesn't look likely. It looks like we're containing this, but I think we have to get through winter. That's always been the challenge for this country, and that's still another 6 weeks away. But if we go to lockdown in New South Wales, it's a third of the economy, and it will completely knock the stuffing out of the economy. And I wouldn't be surprised to see the other side of the W that I'm projecting actually being back to the lows seen in March if we get another lockdown in New South Wales. Thanks.
Thank you very much, Warren. In the interest of time, I'm closing the event now. I would like to thank all attendees for attending today's event. We really hope you liked it. We appreciate any feedback and comments you have. So please email us at engagement-finance@uts.edu.au. If you like, please subscribe to both social media accounts on LinkedIn and Twitter by searching for UTS Finance. And as a forecast, we will have a research finance showcase coming up on 19 August at the same time, 12:30 to 1:30. Stay tuned and see on social media the announcements, please. Visit us on that day to experience fresh finance research in a short and sharp format with an industry commentary provided by Morgan Stanley's Head of Private Wealth Research, which is UTS's Adjunct Professor Nathan Lim. I thank you all for your attendance and wish you a great rest of the day. Bye-bye. Thank you.
Thank you.
Thanks, guys. Bye.
Thank you.